Netflix kicking off tech earnings for the season with its third quarter report on Wednesday after the bell. Our next guest has his eyes on three key things in this report: net number of subscribers added, average revenue per subscriber, and the company's plans for its struggling ad tier. Joining us now is Jason Helfstein, Oppenheimer Managing Director and Head of Internet Research. Jason, great to see you. So you are a Netflix believer, Jason. You got an outperform. I think your target is 470. Why are you bullish, Jason, heading into this report?
While there's been a lot of headlines about what they can't control, which is the rollout of their advertising business, they can control the rollout of paid sharing. That's basically getting kind of some of the more egregious sharers to either pay more money per month or get their own account. And they are purposely slow rolling that. And we think they wouldn't do that if they weren't otherwise confident in their guidance. So, we think for the next two quarters, they've got pretty good control on kind of where the numbers play out. And then they've also told you that a pricing increase will come at the end of the Hollywood strike.
And Jason, hey, it's Julie here. Give us a little more detail on those three things that you're looking for. And let's take the two first, because they sort of go together here. How many subscribers are going to be added, and then the average revenue per member or per subscriber. What are you looking for here from Netflix?
So we have 6 million new subscribers in the quarter. I think that the street is 5.6, and kind of if you look at the high end of the street, they're about 6.5, right? So I think there is a general view that they'll beat the overall street estimate. Question is how much they come higher than that. And then for revenue, basically per subscriber, ARM, we're basically flat year over year. Maybe it'll be a little bit better with currency, but the pushback on the ARM is that if ultimately you're getting more people to opt into paid sharing, right, pay for the unused accounts, why isn't it going up more than that? And there's a thought of, are people downgrading from, let's say, a premium plan to a less premium plan, which the company is saying they're not, or kind of other factors, as well as for folks who are moving into the ad tier, they're kind of behind plan on monetizing that. So to the extent if you do have somebody who, let's say, leaves the kind of the ad-free through paid sharing and ends up on the advertising tier, they're not getting the full monetization of the advertising right now because that's going slower. So that's where the noise is in the numbers, and ultimately that kind of revenue per subscriber, they call it ARM.
And just remind me on the ARM, between a premium subscriber and an ad tier subscriber, what's the ARM for each of those at this point?
So, they've said to us at scale that advertising subscriber could do more than basically a standard subscriber. And ultimately, their standard right now is $15.49. We'll also note that Disney did raise their price for Disney Plus by $3 from $10.99 to $13.99. Then you've got Netflix Premium is at $19.99. And then that kind of, if you want to kind of compare it, you have Hulu ad-free at $17.99. You have Max Premium at $19.99. So it does look like all of the other companies have basically taken, their premium tiers up in price, and Netflix has not. So you have that opportunity. And again, we can talk about it. The advertising business is taking longer than they expected to roll out. You did have the departure of Jeremy Gorman, who was running that business, that's been written about in the press. And so, that is the challenge. I think they thought that they would be further along with an advertising plan or an ad-supported plan than they are today.
Jason, thanks a lot. We're looking forward to the numbers. Jason Helfstein, Oppenheimer Managing Director and Head of Internet Research. Thank you.
Thank you.